Did you know there was no permanent federal income tax in the United States before 1913? So what changed in 1913 that made an income tax seem necessary? How did the government fund itself before then? And how did we end up with a tax system that follows us through almost every step we take? The federal government had introduced an income tax once before, during the Civil War. It was used from 1861 to 1872 to help finance the war, and it was eventually canceled after the war had ended. In my previous video, Hidden Taxes, I showed how taxes quietly appear almost everywhere, in what we buy, what we own, and even what we inherit. In this video, we'll look at how the federal income tax was introduced, why many Americans accepted it, and how the decisions made in 1913 reshaped the American monetary system. In 1913, the 16th Amendment became part of the U.S. Constitution. It gave Congress the authority to collect a federal income tax. Soon afterward, President Woodrow Wilson signed the new federal income tax law. At first, the tax aimed almost entirely at the wealthy. That was only about 4% of Americans. For almost everyone else, nothing changed. The rates were modest, starting at just 1% and rising to a maximum of 7% for the highest incomes. Many believed that asking the wealthiest Americans to contribute a little more would make the system fairer and limit monopolies. The idea sounded reasonable. At the time, huge industrial trusts dominated the entire industry. Oil trust, steel trust, copper trust. Many wealthy businessmen opposed the new tax. They argued that they had earned their fortunes legally. John D. Rockefeller was among those who disliked the growing reach of federal taxation. Ironically, even after Standard Oil was broken into 34 separate companies, Rockefeller remained one of the richest men in the world. Like many wealthy families of the era, he also used legal trusts and estate planning to reduce future inheritance taxes. For most Americans, however, none of this seemed alarming. The tax was small, it affected only the wealthy, and many believed it would be temporary. But history suggests that temporary has a habit of lasting much longer. Today, income tax reaches almost every working American. In most cases, it is deducted before people even see their paycheck. You never hold the full amount in your hands, and what you never receive, you rarely miss. But the income tax wasn't the only major change taking place in 1913. Something else had already begun a few years earlier. In 1907, America was hit by one of the worst financial panics in its history. Banks were failing. People rushed to withdraw their money. The financial system was freezing. There was no central bank to step in. So one man did. J.P. Morgan. He invited America's most powerful bankers and financiers to his private library in New York. The doors were locked. No one was allowed to leave until a solution had been found. Together, they organized emergency loans and restored confidence. The panic was over. America had been saved. But something about this rescue frightened people. Not because it failed, and because it worked. How could one private citizen hold so much influence over an entire nation's financial system? Many believed America needed a different solution. A small group of powerful bankers, economists, and politicians had quietly met on Jekyll Island, Georgia. There were only 6 of them. They traveled in secret. Some even used only their first names to avoid being recognized. To anyone who asked, they were simply going on a duck hunting trip. Later, for years, they denied that the meeting had ever taken place. Only much later did participants describe what had happened behind those closed doors. During those 9 days on Jekyll Island, they discussed the foundations of a new central banking system. 3 years later, in 1913, Congress passed the Federal Reserve Act. Interestingly, the same year America introduced its new federal income tax, and also created the Federal Reserve. One gave the government a new source of revenue. The other introduced a new monetary system. Was that simply a coincidence? I'll let you decide. But before we talk about the Federal Reserve, we first need to answer another question. If there was no federal income tax before 1913, how did the federal government pay its bills before 1913? The answer was surprisingly simple, mostly through tariffs. A tariff is a tax placed on imported goods. Back then, tariffs provided most of the federal government's revenue. On paper, it seemed fair, although it wasn't. The rich and the public were paying the same amount of tax for necessities. Think about it. A worker buying a shirt paid the tariff. A family buying sugar paid the tariff. The tax was built into the price. Most people never noticed it, but they paid it anyway. The wealthy paid tariffs too. The difference was that ordinary families spent a much larger share of their income on necessities. The rich barely noticed the extra cost. Many people believed the burden had become unfair. Consumers paid more, while some of the largest industrial trusts continued to grow. Criticism of the tariff system became louder. Eventually, Congress reduced tariff rates from 40% to 26%. The idea was simple: collect part of the revenue from the highest incomes instead. At the time, that sounded reasonable. If only the wealthiest Americans paid the income tax, most people would pay less than they did under the old tariff system. Then came the crises. And crises have a way of changing almost everything. In 1913, it affected only about 4% of Americans. Then came World War I. The government needed more money. The number of taxpayers grew to around 15% of the population. By the end of the roaring 1920s, roughly 25% of Americans were paying federal income tax. Then came the Great Depression. Government spending expanded, tax rates increased. By 1932, about 63% of Americans were affected by the income tax. And then, World War II. Everything changed. It had become a tax for almost everyone. By the end, 94% were paying. Beginning in 1943, income taxes were deducted directly from workers' paychecks. You never held the full amount in your hand. And what you never receive, you rarely miss. A tax that had once affected only a small part of the population had quietly become part of everyday life. That's quite a journey for something that was supposed to be temporary. Perhaps governments learned something. During times of crisis, people are often willing to accept sacrifices they would normally reject. Wars, financial panics, depressions, emergencies. Each one expanded the role of government a little further. And when the crisis ended, many of those changes never went back. Now let's go back to 1913. As I mentioned before, Congress passed the Federal Reserve Act. In that same year, America adopted its new federal income tax and also created the Federal Reserve. One changed the way the government collected money. The other changed the way money itself worked. The federal income tax gave the government a more stable and predictable source of revenue. The Federal Reserve became America's central bank. Its job was to provide stability of the dollar and influence interest rates. Together, these two changes reshaped the American financial system. Before 1913, government spending was limited by the revenue it could collect, largely through tariffs. Now, things were different. The government could spend large amounts of money because it could borrow by issuing Treasury bonds. Those bonds were attractive because they were backed by the U.S. government, depending on future taxes. Later, the Federal Reserve could purchase those bonds, effectively creating new money in the process. When the Federal Reserve buys government bonds, it doesn't use saved cash. It creates new money electronically to pay for them. In simple terms, the Federal Reserve prints new money to purchase government bonds. And as more dollars entered circulation, each individual dollar tended to lose its purchasing power. That's inflation. A dollar buys less. Inflation erodes the value of money. Inflation creates another interesting effect. As wages rise to keep up with higher prices, many workers move into higher tax brackets. Even if their purchasing power hasn't increased, their tax bill often does. In 1971, President Richard Nixon announced the temporary suspension of the dollar's convertibility into gold. I explained that decision in much more detail in my 1971 video. From that point on, the dollar was no longer tied to gold, giving the monetary system even greater flexibility. The system begins to feed itself. Spend, borrow. Print, inflate the tax, and then spend again. The money wasn't taken from a vault. It was created in the process. $100 in 1913 has roughly the purchasing power of about $4 today. I wish I could create money out of thin air. I don't know about you, but to me, that doesn't seem fair. If this changed the way you see money, subscribe. There's much more to uncover.